want to get the real story on key EI industries. We're going deep into their financials today. Not just the headlines, but the stuff that really tells you how a company's doing.
Yeah, we're talking call transcripts, official results, even some stock snippets. This is about understanding what the numbers mean for anyone following key EI.
So, is this a company to watch, or are there warning signs?
Well, the first thing that jumps out is the growth. Revenue is up 17.21% in Q2 of FY25. For the whole half year, it's a 16.5% increase compared to last year.
That's pretty significant, right? Most companies would kill for that kind of growth.
Absolutely. But here's where it gets interesting. That growth isn't even across the board. Their dealer network sales, basically their B2C stuff, that's seen a huge jump, like 36% this quarter.
Wow, so their housewire segment must be doing really well with regular customers.
Exactly. But then you look at their institutional and export sales, and those are lagging.
So is that a problem, or are they just focusing on what's hot right now?
Well, the company says they're shifting their focus based on demand, making the most of their capacity, which is smart. But is it sustainable?
Yeah, is this like a new strategy for them, or just reacting to the market?
That's the question, isn't it? Are they becoming more opportunistic, maybe a little less focused on the long game?
Or maybe being adaptable is a good thing in a market like this. Okay, so growth is a bit of a mixed bag. What about profitability?
EBITDA margin is holding steady, around 10.42% for Q2 and 10.83% for the half year. So they're meeting their own guidance so far.
Okay, so they're making money. That's good. But I feel like there's a but coming.
There is. Finance costs are up significantly. That's hitting their PEAT margin, profit after tax, down to 6.79% in Q2 compared to last year.
Okay, so that's not great. Is this debt-fueled growth, or is it just a temporary thing?
Well, this is where it gets even more interesting. They just announced a massive QIP, a qualified institutional placement. They're raising $2,000 million.
Whoa, hold on. That's like $25 million. Why are they raising so much money?
And get this, they're saying it's to stay debt-free, even though their current debt seems manageable.
Wait, so they're taking on more debt to avoid debt. Doesn't really add up, does it?
Right. Makes you wonder if they've got even bigger plans they're not telling us about yet.
Maybe some huge expansion or acquisitions. Okay, I'm hooked. Let's dig into their different business segments and see where all this money's coming from.
Well, like we said, Housewire is booming, growing at over 20%. A low base helps, but it shows people really know your brand.
So strong consumer demand, that's good. What about their cables and wires segment? That's still their main thing, right?
It is, but is that growth mostly from low-margin institutional sales, or are they making headway in higher-margin areas?
Yeah, that makes a big difference to their overall profitability. And what about their EHV cable segment? Hasn't that been a bit up and down?
It has. This quarter, they even used some of that EHV capacity for HT cables instead.
Really? Why would they do that?
They're blaming execution delays on utility projects, but it makes you wonder if there's more to the story.
Could be competition, regulatory issues, who knows?
Yeah.
All right. And lastly, their EPC segment. They've been trying to rely on that less, right?
Yeah, it's always volatile. Still makes up about 5–6% of their sales, though.
So taking a cautious approach, but not ditching it entirely. Okay, big picture time. What are your initial thoughts on Key EI's financial health?
It's a bit of a puzzle. Strong growth in some areas, good profitability, but then there's that debt strategy and some question marks around certain segments. We'll need to dig deeper into those financials to really get a clear picture. All right, let's dive into those financials.
Okay, where do we start?
Well, one key metric is ROCE, return on capital employed. It basically tells you how well a company uses its capital to make money.
Like, are they getting a good bang for their buck?
Exactly. And for Key EI, it's looking pretty good. Their ROCE is sitting at 27.2%.
So that means they're using their investments effectively. What about ROE, return on equity?
Another important one, ROE is at 20.2%, which shows they're doing a good job turning shareholder investments into profit.
So not just growing, but growing smartly.
Right. But we can't forget about those debt levels and those capital expenditures coming up, especially that big QIP for the Sanand plant.
Yeah, that was a huge number. What's it going to do to their debt-to-equity ratio?
Well, they say they want to stay debt-free, but this QIP is definitely going to impact their ratios, at least in the short term. We'll have to see how it all plays out once they start using those funds.
It's kind of like a balancing act, right?
Yeah.
Growing fast, but keeping debt under control.
Exactly. Now, let's shift gears and look at their cash flow statement.
Okay, what does that tell us?
Well, it gives us a different perspective on their financial health. Key EI has consistently generated strong cash flow from operations.
So they're actually turning sales into cash, not just profits on paper.
Yep. But their free cash flow has been fluctuating a bit, mostly because of those capital expenditures we talked about.
That makes sense if they're expanding.
Mm-hmm.
But they're also going to have a ton of cash on hand after this QIP. What are they going to do with all that money?
Good question. Officially, it's for the Sanand plant. But with that much cash, they could also make acquisitions, expand even more, or even buy back some shares.
Ooh, share buybacks. Those are always interesting.
Right. Could be a sign they're really confident in their future. Okay, let's zoom in on a couple more metrics. TETs to cash from operations and trade receivables.
Okay, break those down for me. What do they tell us?
So the paid to cash from operations ratio, that tells us about the quality of their earnings. Are they actually turning profit into cash flow?
Got it. And what's EI's ratio looking like?
It's solid, 58.6%. Indicates good cash generation and financial stability.
Okay, that's good to hear. What about trade receivables?
That's the money customers owe them. It's been trending upwards lately.
So does that mean customers are taking longer to pay?
Could be. Might be related to that dealer network expansion. Maybe they're giving dealers more time to pay to entice them to sign up.
Interesting. Okay, and you mentioned realizations and asset turnovers earlier. What about those?
Realizations are basically how much they're getting for their products on average. Right now, it's at a pretty reasonable level. And their asset turnover ratio that measures how well they're using their assets to make sales, that's been fairly stable too.
So not amazing, but not bad either.
Pretty much. Finding that middle ground. Now, those third-party transactions, those need a closer look.
What about those exactly?
Could be anything, really. Outsourcing manufacturing, buying raw materials from someone else.
Sounds a little bit mysterious. Is that a bad thing?
Not necessarily, but we need to dig into their financials and see what those transactions are all about. Make sure there aren't any hidden risks there.
All right, let's put on our detective hats and see what we can find. So we've gone through their financials, looked at the growth, profitability, debt, cash flow, even those third-party transactions.
Yeah, we really dug deep.
And what's the verdict? Is KEI a good bet or what?
I'd say they've got a lot of potential, but there are definitely some things to keep an eye on.
Like what?
Well, that revenue growth is impressive, especially in those consumer-facing segments.
Right, and their EBITDA margin shows they're managing things well operationally.
Exactly. But that huge QIP and them insisting on staying debt-free while going for so much growth, that raises some questions.
Yeah, can they pull it off? It's a tough balance.
It is. And what about those third-party transactions? Did we find anything shady there?
Not really, but it's something investors should definitely watch for. More transparency would be good.
Definitely. Okay, let's talk stock performance. KEI's current PE ratio is 58.6.
Wow, that's high. People must be expecting big things.
They are. High PE usually means high growth expectations. But we got to compare it to their industry and their history to see if it makes sense.
Right, a high PE isn't bad if they can deliver. What about their PEG ratio? That takes into account future growth, right?
Exactly. It compares the PE to the projected earnings growth rate. A PEG of 1 is considered fairly valued. KEI's is currently at 2.
So maybe a little overvalued right now.
Could be. But that's for each investor to decide. We've laid out the facts, the good and the not so good. Now it's about weighing those factors.
High risk, high reward, classic story. So KEI is definitely a company to watch. Can they keep growing without getting into trouble? That's the big question.
And who knows, maybe we'll do another deep dive down the line and see how it all played out.
That's a great idea. Until then, happy investing, everyone.